Good morning. Thank you so much, everyone, for joining us today. I think we are going to look to get started. We can see a few of you are still joining, but I think we're going to get started. Thank you very much. My name is Zoe Addington. I'm the Director of Policy and Government Relations here at the Chamber. And today we're really excited to have Chamber members and experts, Rick Barnett, partner at PricewaterhouseCoopers, and Dean Radomski from Ernst & Young. So they're with us today to walk through the tax changes the federal government is proposing. We're really excited. We've got over 100 businesses registered for this webinar, so clearly this is an issue that businesses and our members care about. We are recording this webinar, so if you do need to leave early or you want to go back to something you heard or even share this with a colleague, it will be available on our website. So as you all know, the government has proposed changes to the tax code. You can find their white paper draft legislation on the Department of Finance website. Their consultation is open until October 2nd. At the Chamber, we will be making a submission that includes feedback we've heard from our members through surveys, through consultations and meetings, as well as making some recommendations. We would also encourage you to send the government your thoughts. So we've prepared a letter for you to use, made it available on our website. You can find it at calgarychamber.com/tax hikes. We've created a sort of a form letter, but please feel free to add your personal experiences and your personal impacts to the letter. It will be, you can click send, it will go to the consultation as well as a copy to the finance minister and local MPs. So one of the most important roles of the Chamber is advocacy for your business. So on this call, we'll tell you more about the tax changes. Oops, were you looking for the agenda? Rick and Dean are going to walk us through this agenda. So they're going to talk about the scope of the proposals, the scope of what the government is proposing, the increase in taxes on corporate reinvestment in passive assets, income sprinkling, capital gains exemptions, as well as converting income into capital gains. The presentation should take about 30 minutes, and then there will be time for questions at the end. Please feel free to submit your questions electronically, and we will be collecting them as we go through the presentation. Questions will be addressed at the end, unless we do see something that comes up that's part of the presentation. It might be addressed in the moment. Please keep your questions short and simple, because they will be coming in electronically as we're going through the presentations. The questions can be typed on the right-hand side under the Questions tab. So thank you very much. I am going to pass it over.
Thanks, Zoe. It's Rick talking here. Glad you can make it this afternoon, and hopefully you'll get some value out of what Dean and I have been given the opportunity to present to you today. Just as an initial comment, there's much has been said in the press over these changes, and I've been practicing tax for a little over 20 years, and I don't think I've seen successive days of news reports on tax changes as much as we've seen on these. And of course, the comments that we're seeing in the press, these aren't really only tax changes, but there are certainly many of the view that these are changes in policies, and policies that have been the mainstay of taxation in our system for private companies for up to, and in some circumstances, over 20 years. Now, our intention is not to do an exhaustive overview of these proposals and not get into overly technical, but to kind of just give you a tax 101 for a general description, but also to give you an opportunity to think more about these policies and how the facts might impact your own business. And from the comments and ideas that you might get from this, we would highly encourage you to talk to your informed tax advisor, as that which we're giving here is not tax advice, but really just to give you a flavor of what might impact your business. So the proposals and the scope that we're looking at, I think as a general comment, they will impact every private company in Canada. The impact on any particular business may vary depending on your facts, circumstances, but again, I think it's fair to say that if you run a private business, there is going to be some aspect to these proposals that could impact how you eventually realize your after-tax dollars. As Zoe had mentioned, there was on July 18th proposal paper, and the proposal paper covered off a few main topics. Most totality, they're kind of grouped into 3 categories. We've expanded ours into 4, mostly around the income splitting and lifetime capital gains exemption. Those 2 are tied together, but again, the main topics are the corporate reinvestment, income splitting / lifetime capital gains, and how capital gains taxation is also affected. There was, in addition to just a consultation paper, actual draft legislation on 2 of the 3 main categories, that being income splitting and the capital gains taxation, which also includes the lifetime capital gains exemption. And then on the corporate reinvestment, there has been ideas or a theoretical approach to how those proposals might be attacked, and needless to say, those are complicated and have not yet had any formal legislation produced. Again, as a general comment, when might these rules apply? And again, they're touted as being private company proposals, and rightly so, because ventures that are in a public corporation, or if the company is owned by a non-resident, there's likely not going to apply in those situations, just by nature of them not being private companies, which, depending on your competitive landscape, you could be up against corporations that these proposals aren't going to necessarily impact, which could potentially impact the competitiveness within your sector. As a sole purpose personal service business, that's really just by nature of how that organization that company would be organized and how income typically flows. We wouldn't anticipate those rules to impact them to any significant degree, but as again, every situation has to have enough facts looked at and analyzed.
And maybe just before we roll off this slide, Rick, it's Dean Radomski. There was a question that popped up, and actually this might be a great time to answer it because if other people have the same question, but the question is, with regard to the proposed policy, why is the government not making a distinction between small business owners and professionals and doctors and lawyers? The answer is not really not that clear why. That, however, may come out after all of the additional information has been provided to the government. So this list here may slightly change. It could be broadened, it could be narrowed, but they never really did distinguish, at least I didn't see anything in there with respect to the differences between a small business owner with multiple employees and widgets being built and this, that, and the other versus doctor, lawyers, and professionals and such.
That's a fair comment, and even some of the comments that have been had, they've just used the term wealthy or high net worth individuals, which again is also subject to a definition that can vary depending on your circumstance.
And who you ask.
Exactly. From that, I'll turn it over to Dean, and he's going to take us through the corporate reinvestment.
Yeah, so we'll tackle the first one here, and the best way to sort of describe this one and give the background to it is borrow a little bit from the white paper, and then we'll sort of talk about the general proposals that are out there. This is one of these systems, this is one of the ones that, or the one that doesn't have draft legislation with it. So as I walk you through this, this is a suggested approach that the Department of Finance has put forward as we're going through the rules here a little bit, or the proposed rules. So these 2 graphs you see in front of you, this is what was provided as part of the white papers that the Department of Finance put forward in their press release on the 18th of July. And you know, looking at the right side first is they showed stats of this trending in this growth of the amount of CCPCs being incorporated. Now there's many different reasons why multiple CCPCs could be opened. and created. And their thought was really this is a growing share of high income self-employed individuals have chosen to incorporate. The slide on the left really shows why that may have happened. So in the slide on the left, what this is telling you is it shows at the bottom dotted line there the combined federal and provincial small business rate that a corporation pays. In Alberta, actually, we're at 12.5 points, and then the green dotted line there just above it is the federal rate without the small business. It's averaged out over Canada here at 26.7 is what the Fed's calculated. It's 27% here in Alberta, as you likely know. So then the combined personal rate currently sitting is at 40 some odd percent. Was it 40? Sorry, what did I mark down? 48% max in Alberta, of course, and averaged out across Canada, they have this 51.6. So as you can see, over time, the corporate rates have declined. Small business a little bit less so than the general rate, but since 2000 and a little earlier than that, the corporate rates have significantly declined in Canada. But however, the personal tax rates have gone up. And so when what this does is it causes the fact that the corporate rates are taxed at a lower rate, is that if you have a business owner or a professional that essentially is earning money within their private corporation, there is a benefit of essentially not distributing out that income immediately to yourself personally to be taxed at the high rates. So in essence, there's this perceived benefit of having this cash deferred inside the corporation, and what the Department of Finance is mostly concerned about is the passive investment earnings that are earned on that capital that's left inside of the corporation. Because had you paid out that capital to yourself personally, you would be taxed at the higher rates.
And Dean, I think this is another way to say it. If you actually look at the consultation paper and the government's definition of fairness, I think what they're getting at is the amount of capital that a particular person would have to reinvest in passive investments. And so I think there's an underlying tone that if you have a lower amount of corporate taxed proceeds, you have more capital to invest, and you get a head start per se.
Absolutely, and so these rules that they're sort of proposing, or not even, I have a hard time saying proposing because there's no actual legislation, but suggesting and looking for feedback on, deal with just that, to try and take away the benefit of having that cash in the corporation to invest. So just repeating myself here, the objective is really to remove that tax deferral benefit when passive investments are acquired from the business taxed earnings, essentially. So they did toss out, sort of two general ways of they were going to think about approaching this. They mentioned this current tax method, the 1972 approach. I'm not going to talk about this. I mention it here because it's in the proposal papers, and actually they took a number of pages to explain it, and then said they're really not pursuing that methodology, and it's tricky, and it's actually dealing with old rates and things like that. So moving on, this second method is really what they sort of wanted to approach and have the consultation about. So really this second method, it leaves the current tax systems generally in place, except removing a refundable component of the investment tax. And so just taking a step back and making sure that we're talking about and making it understandable is that when there's earnings taxed in a private corporation, there is a refundable tax that taxes those passive income investments already. What the Department of Finance would like to do now is having this apply, this old refundable tax essentially apply. However, it's no longer a refundable tax in essence. So this, and I'll walk through an example on the next slide or so, but this removal of this refundable tax would apply to investments earning on corporately taxed retained earnings used to invest in passive assets. And we'll talk about passive assets and what those are, the lack of understanding of what those are in a moment. This would end up resulting in double tax resulting on the distribution of investment earnings, and I'll show you that in the example. But in the end, the goal is essentially that your after-tax earnings is going to eliminate the benefit of the deferral of income sitting in your corporation and tax you the same as had you actually earned that income directly as an individual.
I think the short answer is the mechanics are intended to come up with a way to take away the capital earlier.
Agreed.
Yeah. The
benefit of the capital, sure. And then so this is actually a really high-level example. In previous presentations, we lead up to this example. This is sort of the net result, and given the timing and everything, I think we can walk through it quite quickly. Is that making the example that you see that an individual makes passive income on $5,000, you have the tax rate applied to it, after-tax cash is $2,500. Effective tax rate sort of ties in on the highest marginal rate, which was in the previous slide, around 50 points. When you get into the corporate situation, you have the passive income. Here's this sort of quasi 50% refundable tax that gets applied against the $7,300. It leaves you with $3,700 that then is paid out as a dividend and is taxed again at the personal rates, the regular personal rates and the dividends. That leaves you again with the equal $2,500 of after-tax cash. The difference is your effective tax rate from a corporate perspective now of utilizing that cash inside the corporation is now 66%. And this, there we go. So going through this bottom last 2 points is that this really, if you left your cash inside your private corporation now and reinvested it, at the small business deduction rate, you're ending up now with a 71% tax rate on investment income, 51% tax rate on capital gains, compared to probably half of that on the old rates. And then if it's on the general corporate rate at 27%-ish, then you're now at the 66 points that we saw on the previous slide and 49% on capital gains on your passive income that's generated from that cash that's still retained in your private corporation. So the possible issues, there's many, to say the least. So they're offering proposed grandfathering, or saying they're talking about that, but there's no guidance about how that's going to be. So are you taking a fair market value assessment at the date of implementation? It's very not clear how that's going to go. We don't know how they're going to apply it, and how they're going to actually roll this forward, and when this thing will all become effective. And then the more confusing piece of this whole thing is really, what is a passive investment? So, we look at, is it stocks and bonds that are traded, or is it a small investment in a company that's actually active? It's not even clear if your holding company holds 100% of your operating co, what that looks like. It's just not clear. It hasn't been discussed. We would expect something like that in any sort of future legislation. So right now, this last 2 points here is they're also wondering whether or not, and they're considering it, what about non-CC private corporations? But no mention of public companies, though, as Rick sort of mentioned earlier. So, and they've got some anti-avoidance rules they're going to put in place to stop some, I would say, somewhat aggressive tax planning that was considered in prior years.
And I think, we've started off on the topic that at least Dean and I think has not gotten the most play in the media as of late, but just by some of the effective rates that could occur if the proposals come in as they are theorized, certainly could have a dramatic effect, and then it comes down to what is considered fair, and that's a definition that I think each person can have on their own. But suffice to say, it looks like the government's perspective of fair would be on having capital to invest and not necessarily the effective tax rate that you're going to incur.
Absolutely. And I think it's probably the most challenging piece of all of it, which is why they didn't put together any legislation to toss it out there. with the rest of the other draft legislation. This one's very, very difficult to manage.
Moving on, and we're going to try and get through most of our information and still allow time for questions. On the income sprinkling restrictions, again, I think it's the item that seems to be getting the most play in the media, and we've got a few questions coming in that I hope we'll be able to address throughout the presentation. But just starting off, what's the concern? When they introduce legislation, you always try to go back to what evil is perceived that they're trying to get at, and of course, we've been talking about private corporations, and the ones that are most touted and will be impacted are, have a specific definition in the tax rules as a Canadian-controlled private corporation, of which we're just going to refer to as CCPCs in the remainder of the slides. And really they're taking a look initially at, the ability to distribute after-tax profits to those that, according to perceptions of the minister, that those individuals aren't legitimately involved in the conduct or financing of the CCPC, and where those particular shareholders' income may not be at the top marginal rate, there potentially could be an overall effective tax rate that's lower than those that cannot incorporate. And also, as I mentioned earlier, lifetime capital gains exemption and the impact that the legislation has on those, Dean's going to talk to separately, but again, that's in round numbers, on particularly qualifying property, you can save tax on the first $800,000 of gain in round numbers. And if to the extent that you can attribute those gains on properties to members or family trusts, there might be an ability to multiply access to those exemptions, which again may be a concern of the current government. So what is our current system? Well, one of the coined words that have come up is kiddie tax, and that's really came about because the current rules really talk about the taxation on this specific income of a specified individual to those that are under the age of 18 or 17 and under. And so, with that, the kids of our families are subjected to this top marginal rate where they kind of fall into this split income. We also have what's called attribution rules that we're not going to focus on immensely, but basically those rules limit the ability to shuffle investment income without having bona fide arrangements in place. But what kind of types of systems are in place to allow us to access income sprinkling? There's many structures, but just some typical items. You might have a family trust or a company with multiple shares that have been issued. And again, one of the common uses, and even comes out in the paper, the amount of dividends flowing out to individuals in the ages of 18 to 24 seem to have a higher percentage of recipients than those that are older than 24 to 30, let's say. And what are the dollars we'll be talking about? Well, if you have $220,000, again, depending on your province of residence, that is otherwise taxed in the top marginal bracket of so theoretically income usually over $300,000 if we're talking in Alberta, you could have annual savings if you put that income into the hands of people that have no income. So savings of $25,000 to $30,000. Certainly not insignificant. So if you're going to attack these rules, what are you going to do? Well, there's really two things that they're doing. The first is expanding who, and they're expanding the age group in which these rules apply, and it's not only your kids, but it could be your spouse, and in some circumstances an expanded family, and the split income is actually even broadened a bit as well, or at least the adults that are affected, and they're basically just broadening that definition. And of course, one of the initial thoughts and problems with these rules might be that you could have a 50-50 owned company where both spouses could be specified individuals, and you'd be subjected to tax at the top marginal rate. One would like to hope that that's not an intended consequence, but currently that is an open question that we're hoping will be resolved when the tweaks come in to these rules, as we all hope they will. As well as I referred to expanding the income. So I know one of the questions that came in while we were doing our presentation is, if I'm a single shareholder running a consulting business, can I not worry about these rules? Maybe. Certainly the income sprinkling rules, dividends are only going to come to you, but you can see that, depending if you have family members financing your business, that interest income that they earn on those loans could substantially be impacted. And so you need to look at the facts of your situation and talk to your tax advisors, because they are it just goes to the heart of these rules that they're very broad and they could catch you unintentionally. Again, the excluded amounts, if you get property as an inheritance, that potentially could fall into an excluded amount, and the split income definition not being met. Of course, for individuals that are over 17, there's really two tests. First, the non-university age, theoretically, that are over the age of 25, and they are equating these tests to that being, a rate of return on assets invested or a labor contribution to the business. Now, there has been well-established case law that the receipt of a dividend isn't necessarily commensurate with efforts in a business. However, I don't know, Dean?
And Rick, I think it goes to this question that's been tossed up, is how can they possibly link dividend payments to work done? Dividends are by definition based on the share ownership, and that is absolutely bang on.
Yeah.
And that is the heart of the concerns that everybody, professionals, have with respect to the way they've drafted these rules. The reasonableness test is purely subjective.
And it's not uncommon over my last 20 years that when the department or the CRA loses in court, they change the rules. It's just in this situation, changing the rules with a very broad and difficult interpretation almost makes the rules unworkable.
Yeah, which even goes to the point where, too, is that typically when you have legislation and you engage in a transaction, whether it's a dividend, whether it's whatever, you have to be comfortable that that's not going to get changed on audit. And right now, it's virtually impossible to provide an opinion almost.
That's right. And then when looking at these labor tests, if you have a business that is of more of an investment, i.e. not as active as another business might look, they're only going to be looking at the asset or rate of return and not necessarily the labor exceptions.
And there's another question that just popped up. What about the children under 17? They're already caught by the existing legislation. Yeah. So that's the original kiddie tax that Rick referred to in a slide, 2 slides prior.
Yeah, there actually is one additional item that I'm going to be getting to here that does change for them. And it's really the third bullet point on this slide that can also be, right now, children under 17 or under these rules, if they get taxed on split income, and let's say that's $10,000, and in the current rules, they pay in Alberta, let's just say it's $4,800, I got $5,200 to invest. These rules are contemplating to any income earned on that $5,200 would continue to be split income. And so it does change the cascading effect of these rules. And even as an accountant, I wouldn't want to be having to do that tracking. And I think that's a difficulty to determine. As well, in terms of if you have a child who wants to become an entrepreneur, is it going to impact their ability to be entrepreneurs, as that bullet point highlights. 2 other items that I've just thrown up here that won't work. Your typical estate freeze, where you've kind of maybe introduced a family trust or growth shares into the family. If that child doesn't provide any tangible services, those dividends are going to be subjected to the top marginal rate. And I think, again, the most common use that we've seen is the funding of your children's university might have now become, impacted by those old ways of planning.
Yeah, and the most, irate things that I've heard about, though, is especially the dividends paid to the spouse. Because in a family operation, typically, and it's extremely common, is one spouse basically takes care of the home front, the other one spends the 80 hours a week in the business. Yeah. And not to say that's not a contribution to the business is scary.
And I think, again, it's really how you define fairness, and is that fair?
Yeah, and the definitions within legislation, hopefully they'll tweak it.
Some items that should still work, well, if everyone's subjected to the top marginal rate already, well, then you really weren't needing income sprinkling per se, so it shouldn't impact that. Reasonable salaries, there's legislation longstanding that, salaries are deductible to the extent that they're reasonable. So certainly these proposals don't extend or change that, but the rules are already in place to address those. Again, getting back to, if I do have a 25-year-old spouse and we're able to substantiate what is reasonable for capital or labor, then those should work as well. But again, guidance for what is reasonable is really the whole that we're looking at. And just for the stating that there's still pension income splitting, which these rules don't envision to address.
And almost the one thing I didn't cover, though, in the first part with respect to the capital in the company and just talk about the reasonableness of salaries is that there's been comments in one article in particular which talked about professionals basically plowing back their cash within their companies and then going out and buying their cottage and buying their boat. There are rules already in place to deal with that. Those are personal use assets. Those would be taxed personally because those are, well, they're personal use assets. So I just wanted to make sure that was across, because that comes up almost too much, and even in the commentaries after articles, that's already covered.
And needless to say that everything that we're reading in the press isn't necessarily founded in tax law. So that's why even what you hear in the news or read in the newspapers or on your web feed, you need to consult with your tax advisors. When are these going to be coming down the pipe? So for 2018, so we have a few months left in 2017 to look at your structures. And is there anything that you can do before the end of 2017 to continue to to not be impacted by the rules that change the impact in 2018? So might that be accelerating some dividend payments? Possibly. There certainly could be other things to look at. And again, you need to talk to your tax advisors.
Okay, lifetime capital gains exemption changes. Sorry, there we go. Just quickly following through with this is really tied to the income sprinkling piece that Rick just covered off. Now, the current system, and especially if you're a CCPC owner, you know this very well, is that there is an exemption available to shelter a gain of $835,000, $1 million for farm property, on the disposition of qualifying property, which is really shares, well, very generally shares of a CCPC that carries on an active business in Canada, and plus there's a holding tax test and things like that. Currently, the ability to use the exemption is for all family members, and on an arm's length sale of these qualifying properties, the shares CCPC, and also you can currently, under the current system, allocate taxable gains out of a family trust, which is a mechanism that many people were using, is having their trusts hold shares in the company, and the beneficiaries, upon sale of the corporation, the income would be basically, well, shall I use the term, sprinkled out to the family. And then they would use the lifetime capital gains exemption. So now the proposals to increase the tax is they basically say that there is, oh, thank you, sir, there is no lifetime capital gains exemption now for individuals under 18, and this includes any gains that are accrued at that time. So it bears the question then, when they do turn 18 and they hold shares, there's possibly a valuation at that time, but it's, again, we just have draft legislation, we're not sure yet. There's no more lifetime capital gains realized or accrued through a family trust, even if you roll out that property to the beneficiaries itself. So that sprinkling through the trust to basically multiply the availability of the lifetime capital gains exemption to family members is part of these proposals, and would nix that. And again, this is the painful one, is really the lifetime capital gains exemption. If you're caught by the sprinkling rules on that split income that Rick just walked through, you got to deal with the reasonability tests and the provisional labor, depending on your age, to see if you get the lifetime capital gains exemption. So again, you're back to that subjective piece that is a little bit difficult to deal with.
There was one question that came in, is it expected that these new rules would include family trusts? And I think this is a good spot in the presentation. The short answer is yes. In addition to the large lifetime capital gains exemption, the income sprinkling, where the income is in a business and is distributed out to beneficiaries through a family trust, again, you got to look at your fact pattern, but in general, these rules are going to capture income sprinkled through the use of a family trust.
So this is this little next slide here. Oops, what happened to that? There we go, transitional rules. This is really, really, really important. If you have a trust, or if you've done an estate freeze in the past, or you're not holding the corporation 100% by yourself, because like Rick mentioned earlier, is you're 50-50 with your spouse, the sprinkling rules could apply to you. So this piece here, it's the loss of the lifetime capital gains exemption really starts occurring effective after dispositions, let's say Jan 1. Oops. And so there is an elective provision that they've put into the draft legislation that allows you to trigger gains in 2018 to still qualify. You basically were able to increase the tax cost for future sale. There's some relief to the holding periods test of 2 years. It kind of gets lowered to 1, but you must file this election form. So if you do have more than one shareholder in your corporation, have a discussion with your professional. Now, this transitional rules do not appear to work for minors, where if you're not selling the shares on an arm's length basis to somebody else that's not related to anybody by December 31st, 2018. And I do have to say that's really not on the slides here is that this elective provision, there's without getting into the nuances, there's an alternative minimum tax in a lot of situations that if you're taking that gain and triggering that gain, you may be subject to alternative min tax, which in itself it's just a creditable tax to future earnings, but it's in future employment earnings, essentially.
It basically, you have to have the right type of income.
The right type of income, and so it's again, this transitional thing seems friendly, but or I don't even know if it's friendly, but it's difficult to manage, and it really takes a little bit of work to actually making sure that it actually doesn't cost you a bundle.
And those that are in the audience that would have been tax-paying individuals back in 1994, when they took away the $100,000 capital gains exemption that was available to any property, again, that's a while ago, but tells you how long I've been doing this. There was an election that could be filed to crystallize gains to take advantage of that $100,000 that was going away. This is similar to that, but like as Dean mentioned, there could be other pitfalls that you need to look at and evaluate before you forge ahead. So we're coming to our last topic, and before I get into the slides, this is one of those topics that it's very technical to get into the details to make it truly understanding, so we've tried to keep this one at a high level, but really it does impact on how a company is going to earn its capital gains income, and again, it's something to be mindful of, mostly because it's quite generally and quite broad. So again, what's the concern? What was perceived to be happening is that there were shareholders of private corporations that were able to extract their tax-paid retained earnings or their surplus by means of other than a taxable dividend, and there apparently would seem to be a scheme that the intention is to only distribute profits out of a corporation by way of a dividend. But there were abilities and ways to do that using the existing rules that were all legal and fair to, again, realize capital gains and really strip out those retained earnings at a lower capital gains rate as opposed to what might be a higher dividends rate. And as we talked about before, the court provisions or the court decisions that have been out there, there was a general conclusion that surplus stripping wasn't precluded by any scheme of the Act, and realistically, it weakens CRA's position to try and attack it through other means that they have at their disposal, being the general anti-avoidance provisions. So, long story short, they lose in court, they try and change the rules. So, what are they really proposing to do? Basically, there are existing anti-avoidance proposals that attack this, and in one particular provision, they're expanding it. to try and capture these alternative structures that were being put in place, but they also introduced a second very broadly worded anti-avoidance provision that really can be, right now it can be capturing items that is not intended, and I kind of review that on the next slide. As well, not only are these broadly worded, but they can impact, they're presumably law, or when they become royal assent, they will be effective today. So therefore, a transaction that's happened not only since July 18th and into the future, but certain transactions that were done before July 18th would have to be considered and reevaluated where you're doing a current transaction, because again, there could be a cascading effect and an inadvertent tax consequence that certainly you may not intend.
And I think a lot of advisors have actually focused on that potential of a retroactive piece, because it covers anything that's happened before July 18th. And it's a real scratch your head moment when because of the way that Rick will get to the next slide, how broad these are, it's virtually, well, it's very, very difficult to basically say you're clean.
Yeah, and if you haven't been to the same tax advisor for 20 years, it becomes even more complicated because you have to go back to drudging up old transactional information. And again, what you've heard in the news, it's these provisions that I think have a significant impact on intergenerational transfers of businesses, and again, that's where the clarity is required. Again, I've mentioned it before, the legislation I think is purposefully broad because they were trying to capture transactions that they didn't like, but unfortunately you're also going to be catching basic transactions. And I don't really have an example in these slides, but there has been a question that kind of came up, does the proposal contemplate taxing 100% of the gains that are taxable in a CCPC, or is 50% still tax-free? You need to take a look at your factual situations, because the broadly worded secondary proposal, I think, in of itself could capture, and there's a mechanism within those proposals that, again, the tax-free portion that is referred to in the question, usually as an individual, if I sell a share and half it's taxable, half it's not, the cash in a company is still in the company. So to get it out, I have to have the ability to pay it out tax-free, and there's a mechanism called a capital dividend account. And the mechanisms in these new legislations are actually to create an artificial or a purposeful reduction to that capital dividend account. So the implication certainly could be, if you fall into these provisions, that effectively 100% of the capital gains become subject to tax.
And I'm sure your group is had the same thing happen to you guys as it did to us. We were in the middle of a live deal, and then when this popped out, we had a transaction that was, we felt, completely well, it was benign. It was a management buyout that was going to happen over a period of time, and it was we had to put the brakes on it.
And again, you can come up with many theoretical examples, but the one that I've come into is a business owner that has to make a mortgage payment, and they decide to sell their Bell Canada shares, distribute the after-tax proceeds to make the mortgage payment, and not to get into all the details, but if you read the proposed legislation on their face value, the tax-free capital dividend that arises in that sale of the Bell Canada shares could be caught. And can we say that that's going to be inadvertent? We would think so, that there's going to be some tweaks to the legislation that are going to affect these, but also getting back to the question, the proposals contemplate 100% of the capital gains being tax-free. If we kind of go back to Dean's section where they were talking about the corporate tax on passive investment income, their theoretical proposal is, they would be subject to 100% tax. Again, so they're not currently proposed, but their theoretical proposal is that it would. And again, the one item that when it kind of comes back, does this provision impact all private businesses? Well, when it comes to estate planning, I'm pretty sure that anybody that owns shares in a privately owned company, unfortunately, you're eventually going to die. And these proposals could impact how your estate has to deal with those final estate taxes. depending on your province, your tax rates have gone up by 7 to 20%, and what I'm alluding to there is the difference between the dividend rate and the capital gains rate. And if you can't do things quick enough, you could be subject to double taxation. And so, given the fact that everyone could die, I think you could be impacted by this.
Well, that, and if you've had any discussions with respect to estate planning, you got to revisit it now.
Yeah.
Essentially, that's the message.
Yeah. Just getting to the managing your personal affairs, you have to go back and look at those plans. Absolutely, Dean. And again, mentioned it before in terms of trying to get your intergenerational transfer of a business. The way certain things were done in the past, you can't do them without incurring additional tax, and so there are various examples circulating that we're not going to get or have time to get into today, but it's pretty clear that it's cheaper for the patriarch of the family to sell to an arm's length party than to try and pass it on to the family. What's next?
So thank you very much. So in terms of what's next, so as I mentioned at the beginning, these proposals, white paper, draft legislation is available on the Department of Finance's website. You can go there, take a look at it. The consultation period ends October 2nd. And as I mentioned, the Calgary Chamber is working on a submission. We have been collecting your feedback. We've put out a survey. We appreciate everyone who's participated in the survey. We had a chance to meet with Minister Kent Hare and give our feedback directly and hear from him as well. And in addition to our submission, we're encouraging you to make your views known. So given the number of businesses that have joined us today, obviously this is an important issue, and we hope that this has been helpful in terms of getting a better understanding of what the changes are, what they mean, and how they'll impact your business. We are encouraging you to give your views directly to the Minister of Finance and participate in the consultation. To make that as easy as possible, we have put a letter on our website that you can use. Send it as is or add your personal feedback. All you have to do is include your name. We are sharing right now the link. If you look on the right-hand side, we're including a link for you to go to find that letter and send it. Yeah, get involved, have your say.
And really, Rick, we talked about this a little earlier, is that there's really two components to these. There's the draft legislation that's in there that's complex, it's difficult. I would say the accountants and the lawyers are putting in input with respect to, if you're going to go down this route, this is what you got to fix with the legislation. What I think is very important for the business owner is the policy side of this. How doesn't matter how it's done, but what is done and how that affects your business personally and your decision making within your business and your decision making within your family is, I think, the feedback that the Department of Finance actually does need and is actually asking for in reality.
Yeah, and in terms of the consultation period itself, 75 days from July 18th. I'd like to say that 45 of those days are probably through the heat of the summer. Notwithstanding, there has been questions posed to the minister on extending that consultation period. We're certainly inside of 2 weeks. Is there going to be an extension? I certainly wouldn't hold my breath for it. But needless to say, trying to get as much information into the minister for your concerns or how it's going to impact your business is important. And the tax lawyers and accountants can certainly put through the views that they have, but there's nothing like the groundswell of eligible voters to actually voice their concerns.
Extremely important.
Yeah, no, that's great. That's great feedback, and especially as you mentioned, there's a lot of technical folks like you guys that can provide the technical details, but it is really important to include, those personal impacts. What is it going to mean for you and your family and for your business? In terms of questions, I think for the most part, we did go over the 30 minutes for 30-minute presentation, 30 minutes for questions, because we've been taking the questions as we go, so I hope everyone's okay with that. We did have a couple that we can follow up on.
The one that I think is an interesting question, and it kind of goes back to one of the earlier questions of, is there still do these rules impact the family trust? And I think Dean and I have clearly said that they will. So the next question might be, of course, are there still benefits to having a family trust? I think if you were only setting up a family trust for those immediate taxation benefits that were going to be impacted by these rules, you certainly have to take a sober second thought. But again, the genesis, and when I talk to my clients in setting up a family trust, there still has to be a need, and it's part of that overall estate planning. And we talked a little bit about in the slides that there certainly could be an additional tax on death, which touted in the news is kind of how you kind of get into those really uber high rates of over 70 to 90%. Notwithstanding that, the family trust could still potentially be a vehicle to manage that terminal tax liability.
Great. Yeah.
Just looking at one of the questions here that's popping up. You still have one individual that still has hopes that these changes will not be approved. What do we think the chances are that it is not to be approved? I don't think Rick and I really have any. We're in the same spot you are on that. But
I guess the fact that, again, it's all factual is what we're trying to focus on. Back in 2015, early 2016, there was an announcement that a paper was going to come out for consultation, and not only did we get a consultation paper, but we got rules that they're planning to implement. Some of those rules they were proposing to implement as of July 18th. So the tone would seem to be that that train has quite a bit of momentum, time. They still have to get royal assent, but I think, will there be tweaks? One would hope, because I think the general tax community has pointed out items of unintended impact of these rules. But again, is there going to be a full-out turnaround? I think, not that I want to get into too much of the political side of this, but I think our Prime Minister said something to the effect that he wouldn't apologize for these rules. So take that for what information you get from that.
And the one thing I'm hoping for is, and Jack Mintz with the UFC policy group, and he's been instrumental in many years of Canadian tax policy. I mean, his suggestion was essentially to take a step back from these rules, don't push them forward as quickly, essentially, and really do a type of Carter Commission again to really understand that this is the direction and policy changes that we want, and what do we want out of our tax system here in Canada, rather than just targeting specific investments and specific income levels, I guess.
Yeah, exactly. And again, I think there was an event in Ottawa with the CPAs where the Minister Morneau was able to give a speech and answer questions, and I would like to say that there was at least 2 questions directed at this greater commission, of which I think his answer didn't necessarily directly answer the question. So more to be had on that, but again, it really kind of gets back to it's not just tax changes, it's policy that we're looking at.
Yeah, and I think from the Chamber's perspective, obviously we are advocating for the government to take a step back. As part of our submission, we've asked the government to extend the consultation, give a little bit more time. To Rick's point, this happened over the summer, it was very quick. So we've asked for more time, and we will be asking them to hold off on some of these changes. One of the questions was asked to expand on the meeting with the minister, and I think we were grateful to have his time, give our feedback. We went in with a group of business owners who spoke very sort of passionately and articulately about what impacts they were going to see and what changes, what the impacts would be to them. And certainly he listened and committed to taking our feedback back to Ottawa and back to the sort of cabinet table. But I don't think there was a lot of expectation expectation after the meeting that these changes wouldn't take place. We have been encouraged to provide recommendations so that if the if this isn't what we want to see, then what would we like to see? Because again, the expectation is there are going to be changes, whether we like it or not. So try to be constructive and make some recommendations. So we will be doing that as well. Any other questions? So great. I think we want to end on time and so everyone can get back to work. So thank you again, everybody, for joining us today. As I mentioned at the start, a recording of this webinar will be available on our website. So if there's anything you missed or you want to share it with somebody else, I believe we got to all your questions. Thank you very much. So as I mentioned, the Chamber is here to advocate on your behalf. This webinar is just one tool to make sure that you're aware of what the government is doing and how it will impact your business. Thanks again to Rick and Dean. We're so grateful for your time and your expertise. This has been fantastic. And as I said, please go to our website, calgarychamber.com/tax-hikes, and let the government know what you think. Thank you for your time.
Thanks for having us.
Thank you.